Hello, it's Angie and welcome back to UK Money Wisdom. We're going to try and get a few more videos in before Christmas. There are plenty of requests for different subjects, and the one today is on deferred pensions. Without further ado, let's get cracking. Today we're going to untangle something that sounds clever and sensible, but can turn into a quiet trap if you don't understand all the ins and outs. We're talking about state pension deferral. You might have heard, if you delay taking your state pension, you get more later. It's like earning interest. It's always a good idea if you don't need the money yet. In reality, the picture is much more complicated. In this video, I'm going to walk you through step by step what deferral actually is, the two different systems, old and new, that's pre-2016 and post-2016, exactly how the increase is worked out, how HMRC tax the extra pension, the traps and dangers that almost nobody warned you about, and 4 simple example situations so you can see clearly when deferral might make sense and when it's more likely to harm you. I'll keep the language simple, the pace calm, and the numbers clear. All UK tax details match the 2024-25 and 2025-26 rules as we hold them. And of course, this is general guidance only based on current UK tax rules and public statements. This is not personal financial advice. In step 1, you'll want to work out which system you're in. To even begin thinking about deferral, you must first know which state pension system you're in, because there are 2. One, the new state pension, and that is where you reach state pension age on or after the 6th of April 2016, and the full rate in 2025-26 is around £230 a week, which is about £11,973 a year. Now, the old basic state pension, as we call it, is where you reached pension age before the 6th of April 2016. There's a basic rate plus any additional state pension you built up under SERPs or state second pension. And why does this matter? Because the increase you get from deferring is different. The options you have are different, and the fairness of deferring is very different between the two systems. So before you go any further, you must ask yourself, did I reach state pension age before April 2016 or after? The most accurate way to check is to use the official gov.uk tool to confirm your exact state pension age based on your date of birth and gender. Once you know the date you'll reach it, compare it to 6th of April 2016. Just go to https://www.gov.uk/state-pension-age. And once you know that, we can look at how deferral actually works. Assuming you've all done that, in step 2, let's look at how deferral works now for the new state pension. The new state pension is the system that most people are in now. Deferral is actually very simple at first glance. If you don't claim your state pension when you reach pension age, it's automatically deferred. And for every period you defer, your pension goes up when you do eventually claim it. And under the new rules, for every 9 weeks you defer, you get 1% extra. That works out at just under 5.8% extra for every full year you delay. So, if in the full year state pension is about £11,973 a year, and you defer for 1 year, 5.8% of 11,973 is roughly £695 extra per year. Now your new annual pension would then be around £12,668 a year, paid for as long as you live. That sounds good, doesn't it? Here are the key details. You must defer for at least 9 weeks to see any increase. You can defer for as long as you like. When you finally claim, you get this higher amount for life. So we're clear on that. But, and we will come back to this extra amount is fully taxable, and it can have a big impact on your future benefits and tax. Also very important, on the new system, you cannot choose a lump sum from deferral. It's extra weekly pension only. Okay, in step 3, we will now look at how deferral used to work under the old basic state pension for those who reached state pension age before the 6th of April 2016. The old system was much more generous. Under the old basic state pension rules, for every 5 weeks you deferred, you gained 1% extra instead of for every 9 weeks you defer under the new system. That's 10.4% extra for every full year of deferral. So if your basic pension was, say, £8,800 a year and you deferred for 1 year, you'd get about £915 extra a year for life. On top of that, if you deferred for at least 12 months, you often had a choice of number 1, take a higher weekly pension for life, or number 2, take a lump sum made up of the payments you skipped, plus interest. That lump sum was taxed, but in a special way, usually at your normal tax rate, and treated separately from your other income in that year. That's why you'll still hear older advice saying, deferral is a brilliant deal, but it was much more generous. And for most people, retiring now under the new state pension, the deal is much weaker and there is no lump sum option. So if you're watching this and you're on the new system, ignore old advice that talks about lump sums. It no longer applies to you. For those that are still thinking about deferring though, here is how HMRC taxes deferral. This is where we separate myth from reality. First, your state pension, including any extra from deferral, is taxable income. You never get tax deducted from it at source, but it counts towards your personal allowance, currently £12,570, whether you pay 20%, 40% or 45% tax, and whether your other incomes get pushed into higher bands. When you finally start taking your pension, DWP tells HMRC what your new weekly amount is, including the deferral uplift. HMRC looks at your other income, private pensions, work, etc. HMRC then usually collects the tax by changing the tax code on your private pension or employment. If you are in self-assessment, you must enter the total state pension received in that tax year, including the extra from deferral. You do not enter deferral as a separate item. You just enter the actual amount you received between 6th of April and the 5th of April. The tax bill at the end depends on all your income sources, minus your personal allowances, minus tax already collected via PAYE on other pensions and wages. So in short, Deferral increases your taxable income in future years, and HMRC will collect that tax either through your tax code or through your self-assessment return. So now in step 5, we need to examine the traps and dangers, which is the really important bit. The traps and dangers and how to avoid them. I'll go through them one by one. Trap 1 is thinking deferral is always a good deal. Lots of people have heard, you get 5.8% extra forever. That must be worth it. But here's the reality. You give up a year of pension now in return for £695 extra a year later. That means you need to live many years after you start claiming just to break even. Depending on your health, tax position and inflation, you might need to live 17 to 20 years after you start claiming for deferral to be clearly ahead. If you have poor health, a shorter family life expectancy, or you simply need money now to stay warm and well, then deferral may never pay off in real life. How to avoid the trap? Ask, realistically, will I live long enough and well enough for this to be worth it? Trap 2 is ignoring tax and thinking the uplift is all gain. The uplift looks like free extra money, but because it's taxable in many cases, 20% of that extra will go in tax, more if you're in 40% or 45% territory. So our earlier £695 a year might, after tax, only be about £556 if you're a basic rate taxpayer. If deferral pushes you above the personal allowance or from 20% into 40%, the net benefit can shrink very quickly. How to avoid the trap? Always ask, what will my after-tax uplift be, not just the headline number? For anyone on a low income, this is big. If you get pension credit, housing benefit, council tax reduction, and any other means-tested help, then increasing your state pension later can reduce or wipe out these benefits. So think very carefully before deferring. And you might be better off claiming your pension now and letting benefits top you up today, rather than giving up income now hoping to gain more later, only to have that extra eaten away by a reduction in benefits. How to avoid the trap? If you get or might get means-tested benefits, talk to pension credit or a benefits advisor before deferring. Trap 4 is confusing deferral with the 25% tax-free lump sum. This can be a massive confusion point for some, but let's say it very clearly. The famous 25% tax-free lump sum is for private and workplace pensions, not the state pension. State pension deferral does not give you 25% tax-free. It just increases your taxable weekly state pension. Under the old system, pre-2016, some people could take a deferral lump sum, but this is entirely different from the private pension 25% rule, and it is taxable, not tax-free. And how to avoid the trap? Keep these separate in your mind. State pension deferral, which is higher taxable state pension later, and private pension, which is the 25% tax-free lump sum rules. Right, moving on to trap 5 is not realising the extra dies with you under the new system. Under the new state pension, the extra you earn from deferring generally dies with you. Your spouse or partner cannot inherit your deferral uplift. Under the old system, some extra could pass on. Under the new system, that generosity is largely gone. So if your reasoning is, I'll defer so that my partner is better off if I die, that might not be true under the new rules. And how to avoid the trap? Ask DWP clearly. If I defer and then die, does my partner get any of this extra? For most new state pension cases, the answer will be no. And trap 6, forgetting about self-assessment and tax codes. If you already do self-assessment, when you finally claim your deferred pension, your state pension figure goes up, and your tax bill can jump in that year. If you don't do self-assessment, HMRC may adjust your private pension tax code, reducing your net private pension income to clawback tax. Now this surprises people. How to avoid the trap? When you plan to stop deferring and start claiming, do a quick mock calculation. What will my total income be once I add the new state pension amount on top of everything else? If you're not sure, ask HMRC or use a simple online calculator. In step 6, I think it would be helpful to look at 4 simple scenarios. Let's look at 3 standard and 1 non-standard, shall we? Because I think these 4 fictitious examples will help to bring all of this to life. Do remember these are just teaching examples and not advice. So, in scenario 1, let's look at a standard example which doesn't defer, and that's fine. Mary is 66 on the new state pension. She stops work at state pension age and claims immediately. Her state pension is about £11,973 a year. She has no private pension, no wages, no deferral. So, Mary pays no income tax because she's under the personal allowance of £12,570. She also gets some council tax help. For Mary, deferral would mean losing income now, gaining extra taxable income later, but risking reductions in support. No deferring suits her fine. In scenario 2, we'll look at another standard, still working, deferring for 1 year. John is 66, still working full-time when he hits state pension age. His salary is £30,000, private pension not yet taken. He's in the new state pension system. If he claimed the state pension now, his income would jump. More of his salary would be taxed at 40%. He doesn't need the money yet. So John chooses to defer for 1 year. He continues paying tax on his salary as normal. Next year, when he retires properly, he starts his state pension at about 5.8% higher. At that point, he's no longer working, so the extra pension is taxed at 20% instead of 40%. And in his case, deferral can make sense because he is avoiding stacking state pension on top of a full salary. Scenario 3. This is more complex. We're looking at someone on pension credit, deferring and losing out. Jean is 67. She has the new state pension. If she claims now, she has state pension of £11,000-ish, small private pension, £2,000. She would qualify for pension credit to top up her income. Instead, she sees an article praising deferral and chooses to defer for 2 years. During those 2 years, Jean struggles and lives off small savings. When she finally claims, her state pension is higher, but because of that higher pension, she no longer qualifies for pension credit. Overall, her total income plus benefits is worse than if she'd claimed from the start and received pension credit earlier. That's a good example where deferral hurts rather than helps. Scenario 4. We'll look now at the non-standard danger case where there's ill health and late deferral. Alan is 68. He is on the new state pension system in poor health with a serious diagnosis, but he's read that deferring always makes you better off. He decides to defer for 3 years from age 66 to age 69. He gives up 3 years of pension he could have used to improve his quality of life. At 69, he starts a higher pension, but sadly, his health declines further and he dies at 73. In that case, he lost 3 full years of pension. He gained 4 years of a slightly higher pension. His partner cannot inherit his uplift. Financially, deferral left him much worse off in real life. That's why health and life expectancy matter so much. Poor Alan, I wish he'd had the right advice. Finally, I'd like to finish with a quick deferral checklist. So before you choose to defer, number 1, check which system you are in, either the new state pension or old basic state pension. Number 2, do you rely on benefits or might you? If yes, deferral may reduce pension credit or housing benefit later, so be careful. What is your realistic health and family longevity? Deferral only pays off if you live long enough to benefit. Number 4, what will your total income be once you stop deferring? Will the higher pension push you into tax? Number 5, are you mixing up state pension deferral with private pension 25% lump sums? You must keep those systems separate. Number 6, have you checked how your partner would be affected? Under the new system, remember, your extra deferral usually dies with you. If after all of that you still feel deferral fits your situation, it can be a useful tool, especially if you're still working and don't need the income yet. But it's not as attractive as it was for those who retired before the 5th of April 2016, not nearly as attractive. And if you're at all unsure, it's completely okay to take the pension when you're first entitled. Use it to look after yourself and seek personalised advice if your situation is complicated, as some of your situations are. All UK tax details match the 2024-25 and 2025-26 rules as we hold them. And this is just general guidance only, based on current UK tax rules and public statements. Please speak to HMRC, a regulated advisor, or a free guidance service like Money Helper or Pension Wise if you need personal advice. You won't regret it. If this has helped you feel clearer about deferral, be sure to subscribe to receive all my videos, and please like, share in case you have somebody who could well use this video, and do leave a comment with your own situation without any personal details so we can help more people understand the system. My goodness, you deserve clarity, dignity and confidence in retirement. We all do. I'm Angie and this is UK Money Wisdom, and I'll be back with you again very soon. Goodbye.